Hi class, and welcome to this video, part of VCE Year 12 Economics, Unit 4 Outcome 1. This video is focusing on monetary policy, and specifically we're going to look at the transmission mechanism of monetary policy. And we're going to discuss what that means, but essentially we're thinking about how do changes to the cash rate flow through to influence aggregate demand and inflation. Now, if you look at our key knowledge summary list here, you can see that it is our third key knowledge point for monetary policy. So there is assumed knowledge that you understand what the RBA is, why they are changing interest rates, and we know that's to control inflation, and how their mechanism actually works. What this video is going to focus on is how the transmission mechanism occurs. Specifically, how does changing the cash rate influence aggregate demand and inflation. And we're going to look at 5 ways that this occurs, and this includes savings and investment, cash flow, availability of credit, exchange rates, and asset prices. And these are all influenced by the cash rate changing, and these all influence aggregate demand and inflation. So let's think about, before we go into these specific topics, what we actually mean by the transmission mechanism of monetary policy. Essentially, it's pretty simple. We know that the RBA controls one thing only, and that is the cash rate. But the transmission mechanism refers to how changes in these cash rate is going to impact, firstly, interest rates, but then secondly, economic activity and inflation. So how does it flow through the economy, changing one cash rate to impact economic activity and inflation? Because if we remember, the RBA, if they reduce interest rates or reduce the cash rate, to be specific, they are trying to increase economic activity. And they recognize that that will potentially increase inflation. If the RBA decides to increase the cash rate, which they're doing now in July 2022, they know that this will reduce economic activity, and they're happy to do this because they recognize that there is a need to do that because they need to reduce inflation, because inflation is above the target range, just like we have now. So what are the 2 stages that we're really going to focus on? Stage 1, we're going to think about how do other interest rates respond to the changes in the cash rate. This is referred to as the interest rate pass-through, and it is a pass-through as generally the interest rates rise on fall is passed on. Sorry, it is a pass-through as generally the cash rate rise or fall, this should say cash rate, is passed on to all interest rates due to the competition for funds. So if the cash rate increases, savings accounts will expect the same increase. And this will increase an expectation and force the banks to increase savings accounts interest rates. Now, this is a cost to production for banks. They have to pay that to their customers. So this will increase the loan interest rates because the banks will see their costs, savings rates going up, and they will pass this on to loan interest rates. So that's really all we need to know there. The interest rate changes occur due to interest rate pass-through. The rest of this video is going to focus on stage 2. How does the change in these interest rates impact economic activity and inflation? Now, there are 5 ways that interest rates impact economic activity. And when I say economic activity, I'm talking about aggregate demand and GDP. And inflation as well. This video is largely going to focus on aggregate demand, and we're going to talk about this a lot. But remembering, if aggregate demand goes up, it's likely to result in inflation going up as well. And this has likely occurred because interest rates have gone down. Aggregate demand will go down, and this is generally a response because we are trying to reduce inflation, and this occurs if interest rates go up. There are 5 possible ways that the interest rate changes can transmit their desired effect onto economic activity and inflation. The cost of credit, also saving, and particularly the cost of savings and investments, cash flow, the availability of money or credit, the availability to get a loan, asset values and prices, and exchange rates. Essentially what we are saying is that all of these 5 things are going to be impacted in some way due to interest rate changes, and in some way they're going to impact economic activity in a way that we desire. And here is a bit more information. The RBA recognizes this, and you can see that there is some similar headings here, but we're going to focus the ones on our study design. But I put this in because the RBA recognizes this, and you can see this is directly from the RBA. Now, the first one we're going to think about is the cost of credit, and it's particularly the cost of savings and investments. Let's think about this simplistically before we go into it. If the interest rates increase, this will make borrowings more expensive, but the rates that you'll get on your savings will also increase. If interest rates decrease, this will make borrowing less expensive, and savings rates will decrease. So in terms of our savings, if we have a lower cash rate, and that means we want more aggregate demand, we want to drive GDP, lower interest rates, lower deposit rates are going to reduce the incentive for households to save their money. Why would you save your money if you're going to get less of a return on this? This gives them an increased incentive for households to consume. Now, if they're consuming, this is going to increase aggregate demand through increase in consumption. So you can see the lower cash rate will create an increase in aggregate demand, the desired effect, because of lower savings rates. Now, of course, higher cash rates are going to mean higher deposit rates. There is going to be higher interest earned on their savings, and this will increase the incentive for households to save their money, reducing the incentives to consume, and this will decrease aggregate demand. So a higher cash rate, higher interest rates is going to result in a decrease in aggregate demand, what we are desiring, because of higher deposit rates. Now, the cost of credit for investments is also going to be impacted. A lower cash rate is going to be lower interest rates, lower lending rates, and this is going to encourage people to increase their borrowing, increasing their investments. Now, but people are getting more borrowings, they are going to be able to increase their aggregate demand because they are going to make investments. They're going to spend that money that they're borrowing, and they're more incentivized to do this because of lower interest rates. And again, we can see lower interest rates are creating the desired effect of higher aggregate demand. Higher cash rates are going to equal higher lending rates. You're going to have to pay more interest on your investments, and this is going to discourage households to increase their borrowings. And this will decrease aggregate demand. So we can see higher interest rates are going to result in lower aggregate demand, the desired effect, because people are going to be saving more money and investing less. Lower rates, people are going to be saving less and investing more in terms of borrowings, creating the desired effect. And this is summarized here. You can start to see if the cash rate goes down, we're going to see lower deposit rates and hence lower savings, lower interest rates on investments, and hence higher spending. And that's what we're wanting. Less saving, more spending, because that is going to equal an increase in aggregate demand. Now, remembering that will also increase our inflation, but the interest rate, the RBA has made a decision that they're happy with this because they've reduced their interest cash rate because theoretically inflation must be below the target range. Now, the next thing we're going to think about is cash flow. How much cash is in there? Now, if there is a higher cash rate, there is going to be a higher repayments on debt. Now, this is going to impact, if there's higher interest rates, this is going to negatively impact those of people that have loans, and particularly those that have variable rate loans, because that means the rate goes up and down according to the changes in the cash rate. So households and businesses with lots of debt, so with net debt, more borrowing than savings, will suffer an immediate reduction in their cash flow and discretionary income, as they're going to need to have more of their income spent on interest payments. So if you have to spend more of your cash on interest, you're going to have less cash to spend on other things. This is going to reduce household consumption, so C, and hence also reduce aggregate demand. So we can see higher cash rates are reducing aggregate demand because high repayments are going to result in less cash. Logically, lower cash rates are going to have lower repayments on debt, particularly those with variable rates. So people with net debt, more borrowings than savings, will benefit from this. And this will increase their cash flow. They will have more discretionary income, and hence this will increase their ability to consume and spend, leading to and this should say, increased aggregate demand. And I apologize for that. So again, lower cash rate, less money spent on interest, more cash in households and businesses to spend as they wish, increasing consumption and maybe even investment. And you can see here, again, the flow on here. If the cash rate goes down, we're going to have lower mortgage rates, lower repayments, and hence people are happy to spend a little bit more. Now, we should remember that some people are going to not be have net debt. Some people are going to be net lenders. They actually have more savings than that. They're not going to be happy with this, but most people are. Most people in Australia have high amounts of debt. Think about the home loans that they've had to take out. So that's why it typically flows through like that. Now, the next one we're going to think about is the availability of money and the availability of credit. Essentially, what we're thinking about is how easy is it to get cash. Now, if you don't have cash in the bank account, how do you get it? You get a loan. So we're essentially thinking about how easy is it going to be for people to get a loan when interest rates go up or interest rates go down. Now, if there is a higher cash rate or a higher interest rates, that's going to mean that less borrowers are going to be able to afford loans, be able to service their debt. There's going to be less people going to be able to pay their interest payments. Now, the banks are going to recognize this and make it harder to get loans, so there's going to be less availability of money or credit. So in times of higher interest rates, it's less likely that consumers and businesses will meet the lending criteria of banks, because there's always a criteria that a bank needs to tick off before they will give a loan. Can you pay the money back? This means that borrowers are less likely to receive money or credit or cash. And if you are getting less loans and less money, this is going to result in a decrease in consumption and investment spending, reducing aggregate demand and economic activity. So hence, higher interest rates are going to reduce aggregate demand, reduce activity, reduce inflation because there is less ability to get loans. Now, of course, conversely, lower cash rates, lower interest rates means more borrowers can service their debt. More borrowers will be able to get loans. There will be more availability of money and credit. This is going to lead to an increase in consumption and investment spending. And I apologize, I have made this mistake again. Increasing aggregate demand and economic activity, because more loans, more people able to meet the criteria for loans. This is because the risk of default is decreasing, more money in people's hands, hence more spending, more aggregate demand, more inflation potentially, but that's the desired effect of lower cash rates. Now, in terms of asset prices, a higher cash rate is going to result in a lower demand for people to buy assets. Why is that? Because people are going to have less cash, less ability to get those loans out, because there is going to be higher interest rates. The price of these assets will likely decrease as the demand for these assets will fall. If you're getting a house, maybe even a car, you're most likely going to have to get a loan to do that. Now, because of that, you're going to have to pay interest on it. So the higher cash rate is going to mean that you're going to be less likely to want to buy that expensive house because it's actually become more expensive, and hence the demand for these assets fall. This reduces the average wealth on paper of people and also reduces the aggregate demand because people are going to have less confidence. You're less confident if you're feeling less wealthy. Lower cash rates are going to result in higher demand for assets. And if we think about this, we've been in a really low cash rate, interest rate environment. And what has happened to house prices over the last 10 years? They've gone up significantly. So lower cash rates are going to result in the price of assets increasing as the demand for these assets will increase. This increases the average wealth on paper of people and real wealth if they decide to sell these assets. And this increases aggregate demand because people are more likely to spend because they have more confidence, hence more economic activity. And you can see here, as we've talked about, cash rate going down is going to result in home loans going down. This is going to result in house prices going up because there's going to be more demand for houses because people are going to want to feel like they're more affordable, and hence this will increase confidence and hence spending. So cash rates going down, increasing spending in C or I, therefore an increase in aggregate demand. And I believe this is the last one. The last way that cash rates and interest rates can impact things is the exchange rate. If we have a higher cash rate, we are going to have higher returns for overseas investors. People are going to be more likely to demand Australian assets. They're going to want to get that higher return. What does that mean? A higher demand for our exchange rate, for our Australian dollar, and this will lead to an appreciation of the Australian dollar. Overseas, as we mentioned here, overseas investors will demand more Australian assets because they're going to get a higher return, resulting in a higher demand for Australian dollars and Australian dollar appreciation. This is going to make imports less expensive and reduces inflationary pressures. But it also makes exports less internationally competitive because they're going to be more expensive. Our dollar has gone up. So you can see that this is going to result in a reduction in our aggregate demand because we're going to have more imports, so less money staying in our country, and less exports. And we know that aggregate demand involves X minus M. So the higher amount of imports is actually reducing our aggregate demand. And we can see this is going to make them more desirable because imports are less expensive. And our exports are going to be more relatively expensive because of this. Conversely, lower cash rates is going to result in a lower return for Australian investors, for overseas investors, Our Australian dollar will depreciate. This is going to make imports more expensive. It's going to make exports more competitive. So we're going to have more exports. So this will reduce our aggregate demand. Now here is where I don't often do this in my videos, and I'm not going to put the answers up here, but this is a good do now activity. You might want to pause the video and have a look through. If you're in my class, you have access to the answers. Can you look at these statements and work out, which part of the transmission mechanism is going to be impacted? But for now, I hope that this video has explained the transition mechanism, which, as we remember, is how we can go from a cash rate change, which the RBA controls. How does that flow on to interest rates? Economic activity, which is all about our GDP, aggregate demand, and ultimately inflation. We know that there are 5 ways that this really happens: savings and investment, or demand for savings and investment, cash flow, availability of credit, exchange rate movements, and asset prices. And hopefully you've seen this relationship where cash rates go down, interest rates go down. This will impact and result in an increase in economic activity because of the desired impact by these factors, and this will increase inflation, and the opposite will happen if we increase cash rates. I hope you found this video helpful and keep studying economics.